One great wedge pattern. Look at how when it broke out, it was a awesome breakout. Now, I do think you are going to get a retrace here. We're probably going to come back towards 4,000, maybe even 3,900. But at this point, once you get the breakout, you buy the pullbacks. This downtrend has been broken. All right, that's number one. We're starting to get slightly higher lows and now slightly higher highs. And so, again, the breakout is there. I do have it penciled out based on a calculator and calculations that I've done is that by 2029, 2031, we'll be at 13,000 on gold. That's my calculation at this point.
Gold has completed a decisive wedge pattern breakout, officially concluding its previous downtrend and establishing a sequence of higher highs and higher lows. Immediate price action may experience a brief retrace toward the $4,000 or $3,900 range, offering strategic accumulation zones before upward momentum accelerates. Gareth Soloway, a seasoned market technician and chief market strategist, emphasizes that fundamental market vulnerabilities and mathematical cycles will drive an unprecedented multi-year expansion for precious metals. Detailed technical calculations indicate that gold is systematically charting a path toward $13,000 per ounce between 2029 and 2031. While a remote downside worst-case level sits at $3,500, structural forces heavily favor accumulating physical metal on every pullback. Across broader markets, near-term projections forecast a rally pushing Bitcoin into the $70,000 to $80,000 corridor, while the S&P 500 targets 8,200 before stagflationary headwinds emerge in 2027. Now, we present the clips from Gareth Soloway's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Well, I think gold is going much, much higher. It's just a matter of the time. So number one, great wedge pattern. Look at how when it broke out, it was a awesome breakout. Now, I do think you are going to get a retrace here. We're probably going to come back towards 4,000, maybe even 3,900. But at this point, once you get the breakout, you buy the pullbacks. This downtrend has been broken. All right, that's number one. We're starting to get slightly higher lows and now slightly higher highs. And so, again, the breakout is there. I do have it penciled out based on a calculator and calculations that I've done is that by 2029, 2031, we'll be at 13,000 on gold. That's my calculation at this point. So I think, listen, there's a small part of me that still thinks gold could go down to 3,500. That was kind of my worst case scenario where I'd be like buying with both hands, physical metal, etc. It only got down to 3,900. But at this point, you know, you see the writing on the wall. Like we've talked about it in this interview, all the negatives that are ultimately a positive for gold, even silver, and so on and so forth.
You know what's interesting, and I'll come back to gold in just a minute, but you know what's interesting is that we talked about the gold price popping, we talked about S&P popping around the end of July. Bitcoin's still flat. In fact, it's down today.
Yeah.
In fact, gold's up and Bitcoin's down today. Yeah, Bitcoin, just whatever moved the markets, by the markets, I mean the stock market, whatever moved the stock market at the end of July, whatever moved gold, that force did not have any impact on Bitcoin whatsoever. It's still flat.
Yeah, and what we're seeing is, so number one, we actually did get a breakout on Bitcoin, and it's probably one of the weakest breakouts I've ever seen in my life, because you can see this trend line goes to the from the all-time high down to this pivot. We hit it, then we hit it again 3 times here, and we finally got through the line. Now with gold, what did gold do? When gold got through its line, it like ripped higher. Bitcoin just petered out, and as long as it stays above this white line, there's actually a bullish angle to this, meaning probability actually favors upside here in the near term on Bitcoin. And what we're seeing is, so number one, we actually did get a breakout on Bitcoin, and it's probably one of the weakest breakouts I've ever seen in my life, because you can see this trend line goes to the from the all-time high down to this pivot. We hit it, then we hit it again 3 times here, and we finally got through the line. Now with gold, what did gold do? When gold got through its line, it like ripped higher. Bitcoin just petered out, and as long as it stays above this white line, there's actually a bullish angle to this, meaning probability actually favors upside here in the near term on Bitcoin. But I think what's going on here is that you have all these other assets. I mean, semis are starting to rally. The stock market's at all-time highs. Gold is going. Bitcoin, who wants to be in Bitcoin at this point? Like, no one. I mean, even Michael Saylor's had to sell like 100 million to cover and buy other things and cover dividends. The one thing, again, I will say, I'm short-term bullish on Bitcoin, and I think also the Clarity Act issue. So you had the Congress punt the Clarity Act to the next session. That just happened days ago when they went on break. Now they're not coming back till September, so I would think that probably late August you start to see an uptick here. But we're just continuing to hear that these meetings, these things on clarity, it's just not helping. It's not getting forward, and that's honestly disappointing for anyone in crypto who voted for Trump because he was pro-crypto. The crypto stuff has really not panned out. And my thesis here is, and I'll tell you this, one of the reasons why I'm near-term bullish is I do think that the president will want to get crypto voters back to the polls or back to the voting boxes in November, and he's going to try to push that Clarity Act through before the midterms. And I think that will give you a 10% to 15% run in Bitcoin, maybe even more, taking it into the 75,000 range. What I will say, at least for Bitcoin is the one thing out of all of them that at least maybe there's a glimmer that it's that alternate to gold, or that angle to, diversifying against money printing and fiat. Now, again, every bear market, people doubt it. But so far, the bear markets have been every 4 years, and it's come out the other side. I'm not convinced the ultimate low is in for this cycle, but I am convinced pretty highly that we will see a rally in the near term here over the next month or two in Bitcoin that'll send it up again, back into the mid 70s, maybe even touching 80. Again, that'll be based on whether or not the president starts to court those investors and gets excitement back.
Bitcoin has exhibited an unusually sluggish breakout compared to traditional equities and precious metals, yet price action continues to hold firmly above its critical descending trend line. While alternative risk assets rallied strongly throughout recent market sessions, digital assets largely moved sideways as institutional liquidity rotated towards surging semiconductor benchmarks and corporate balance sheet requirements. A major fundamental headwind involves legislative stagnation, with Congress punting the Clarity Act into the upcoming session before taking recess. The lack of swift regulatory movement has disappointed market participants who anticipated immediate institutional support. Nevertheless, historical 4-year market cycles show digital assets repeatedly weathering consolidation phases as sovereign currency debasement and fiat expansion persist. Now, let's get back to the interview.
I didn't even, believe it or not, ever since Kevin Warsh was put into the chairmanship, I have been steadfast on this. And I've even said, I think we can go back to our past interviews. I said he will not raise interest rates. And two factors there. Number one, I actually believed President Trump when he said he would never appoint someone that was going to raise rates. And number two is, while Kevin Warsh in his last press conference talked this great game, we're going to get, prices under control, we're going to do this, and we've even had hawkish members of the Fed come out and be super hawkish and talk about raising rates, there's been very little detail. Like it's a lot of hardcore talk, but there's nothing backing it up, and that's telling me everything I need to know. And now, miraculously, we're seeing all the pieces of the puzzle fall in. Labor markets weakening, retail sales, which tells you the consumer's hurting. We see oil prices staying somewhat elevated, but not at their highs, so it's not really pushing inflation up. Everything's falling into place, including the supposed CPI and PPI numbers, which came in this week and were basically muted, in line, or slightly better than expected. It takes all the pressure off, and thus the Fed watch tool's now telling us that. But I would not overestimate the influence that can be put on other members of the Federal Reserve. Now, listen, there's going to be a few that won't be influenced, and we've seen that in, I think, last one, there were multiple Fed governors that wanted to hike rates, but there is always going to be someone who can be swayed, especially when the data is starting to weaken. I mean, think about it. If you're one of those 4 governors that votes for a hike and you raise rates, and then all of a sudden the jobs data collapses, think about the pressure. So the easy out, as human beings, we like to generally take the easy out, is to say, oh, well, at least if we're wrong, it gets blamed on Kevin Warsh. But if Kevin Warsh doesn't want to raise rates and you're one of the people that pushes it, then it's falling on your head, and people just don't want that pressure. And so I think that some will, and I think they want some. I mean, think about it like this. The Federal Reserve is going to want people to say, hey, we want to raise rates, and even some vote for it, because it keeps the independent look of the Fed. It keeps the hawkishness on there, and so it keeps control of the situation. But ultimately, what is the outcome? I guess we'll find out. But I say no rate hikes the rest of the year, and I say cuts in 2027. I think inflation is going to stick in this 3 to 4% range, and then ultimately the labor market is going to continue to weaken here, and we will see essentially a mini stagflationary scenario in 2027, and that's really where I worry about the stock market. I think through the midterms, probably fine, maybe 2%, 3% drawdowns, which is just normal, but then pushes to all-time highs. I think we hit 81, 8,200 by year end. Then starting in 2027, that's where I'm going to get concerned. Now, let me show you this chart here, and this is why I think the 82 to 8,300 level is appropriate to mark on. So number one, here's a chart of the S&P 500, right? So we were in this parallel channel since COVID's low, bull market 2021 highs, and we talked about this in past interviews. Here's your lows of the bear market in 2022 and 2023. Here's your tariff sell-off down to that same trend line. We then went to the high end, but look, we broke out. So we broke out of the channel, and then all of a sudden, a resistance level, remember, it was resistance here and resistance back here, it now became support. And so this is kind of my level in the sand, if you will. As long as we stay above here, it remains bullish, and it held, and we've gone higher. Now, if we continue up, there's one thing that is paralleling here. We take a trend line right from here, right? So these levels, and essentially we bring it up to this high point here. Okay, and I'm going to change the color on that so it pops out for all you guys that are watching. If you look at that, that's the logical next parallel to get hit. And where is it? It's right around 8,200, 8,100. Now, you might say, okay, well, it's a parallel, no big deal. I want to show you another chart that's even wilder here. So let's get rid of these drawings. Let's do the S&P divided by M2 money supply. Now, the reason why M2 is so important is that M2 is how much money's in the system, essentially. So in theory, the more money in the system, the more money that's being created, the higher the stock market can go, because some of it always finds its way in. So if we go to US M2, so let's divide SPX by US M2, and we bring up this chart, I want to show you this. If we go to our weekly chart and we go back to the .com high, right here. So here's your .com bubble high. Here's your low from 1982. Here's your collapse, financial repression or recession, the big financial crisis low. So you're connecting two pivots, and guess where this would go? How much higher it would go if we hit 8,200 on the S&P? We would top out on the M2 money supply factoring when looking at the S&P. And I hope I explained that clearly enough, but that would essentially mean that we are more expensive in terms of M2 than at the .com, but it would be essentially the high of the parallel channel or resistance. So the two factors, the S&P level there and the S&P divided by M2 money supply, right there at 8,200, I think that's where we're headed, and that's where we could see that next big drawdown. I also think there's a bigger dynamic going on with the U.S. dollar. You brought up the dollar yen just a little while ago, but look at the U.S. dollar breaking here. And we know the stock market likes a weak dollar. Multinationals make more money when they convert those other currencies back to dollar if the dollar is dropping. And then the 10-year yield and the 30-year yield, which still remain at ridiculously high levels, at least they're not pushing up, right? So if we go to the 10-year yield here, and we take a look, you can see it's really flatlined ever since, interestingly enough. I mean, you could really go back to May, the high pivot in May. We've just been stalling around here, and that's giving investors a little bit more confidence that, essentially we're seeing a slowdown. And I think we can't overlook, and sorry to ramble here, but we can't overlook the oil price as well. Oil, again, was popping up as missiles were flying and strikes were going on, and all of a sudden, basically, the president has said we're going to do economic sanctions on Iran, but we're not going back to missiles and attacks. And what does that mean? It means the midterms are getting pretty darn close, so we can't be having a war and continual casualties going into midterm elections.
Federal Reserve monetary policy faces mounting internal friction as macroeconomic data reveals cooling employment figures, slowing retail sales, and persistent baseline inflation. Although central bank governors frequently broadcast aggressive hawkish rhetoric to project institutional independence, aggressive tightening lacks data-backed justification when consumer spending weakens. Valuation metrics calculated by dividing the benchmark equity index by the US M2 money supply highlight a pivotal structural dynamic. Whenever equity valuations stretch relative to total system liquidity, overall market multiples encounter long-term ascending resistance boundaries directly comparable to the dot-com era. This ongoing multi-year parallel channel demonstrates how previous resistance thresholds have steadily converted into baseline technical support. Simultaneously, currency fluctuations and bond markets heavily influence corporate balance sheets. A depreciating US dollar creates a strong earnings tailwind for multinational firms repatriating foreign profits. With 10-year Treasury yields flatlining below previous pivot highs and geopolitical oil risks shifting toward trade sanctions rather than active military escalation, broad financial conditions remain momentarily stabilized against underlying economic headwinds. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.